Okay, hello traders. Welcome to this live intraday strategy webinar on SB Trade Desk. Today is Thursday, August 26th. Mike Boutros with you on the horn. Great to be here. Jay, Steve, everyone in the room, welcome. All right, it's been a while. I was off for the early part of the week, but we do have Jackson Hole on tap, and everyone's really watching for what Jay is going to say tomorrow. Now, you did get some ancillary comments coming out today. From some other Fed members, again, really hinting that we may be looking at tapering sooner rather than later, and not just sooner, but at a faster clip, which is some interesting commentary that just came out. But in any event, we're focused on the trades, and there's a lot to look at. So on the menu, DXY, Euro, Dollar CAD, crude, Bitcoin with a quick look there. It still looks like a possibility for a little bit of a pullback. We'll look at those levels. Kiwi, Aussie, dollar, yen, and gold. Any other questions or trade setups? As always, feel free to throw them on the message board at any time, guys. All right, so here's what we're looking at with the dollar. Slight variation here. I put this chart up yesterday. It looks like, again, we came and we turned just pips ahead of, here's the weekly and where the weekly stands now, ahead of the near-term 100%, 1618, but in any event, the weekly, just ahead of that 100% extension, right? 93.76, the high registered at 93.72. That was the high last week. We closed right below. Here's the pullback. Now you're getting, it's not a divergence signal because this is actually a higher clip, but it looks like it's just a little bit toppy here, just ahead of the resistance zone. One thing we wanted to note that this was an objective break of the yearly opening range. And if you look at the highs from back here in March, we're actually we closed basically right there and it pulled back. So I am favoring the long side still. I do think we get a push higher inevitably, but from here, the risk still for a little bit weaker of a drawdown before resumption. Momentum, I want to see 60 break. Remember the longer term. These are the momentum signatures that really tell the most, right? Strong uptrends, you see support at 40. Strong downtrends, you see resistance at 60, right? So we haven't gotten a break out of the 40-60 clip since the low. It's kind of what you want to see to give you the fuel, the evidence to support the notion that dollar has indeed bottomed. So that's bigger picture, longer term, weekly chart. The daily chart looked like this. A little bit different of a picture here, and that big lateral zone of resistance that we talked about actually did not hold. Right here, the high day close from back in March, the high day close from November of last year. Look at 93.23, 93.40. I was talking to you about that for a while, right? Turned just ahead of it back last month. This month, here's the break. And while it did close above on a daily basis, we pulled right back below into the start of this week. So again, near-term levels to look at. Slope, here's the median line for the same formation we've been following off the low. That's a little bit lower from where we are right now. I think I gave you guys like 92.75 yesterday as a level. And just below that, the 618 of the advance off the July low. So both levels of which, if reached, I am starting to look for possible waning downside exposure, possible exhaustion, possible entries, right, for a larger play there. But this really is what I would want to see. I do not want to see anything below this if we are heading higher. Key resistance, I'm still going to want to break above 93.40 for the resumptive move. So again, a little bit of a pullback. You're seeing that materialize. Here's what the scalp looked like. If you guys remember, the previous update, here's what the scalp looked like last night. The previous update was working with a different slope. It was working with this trend line, okay? A little bit tighter. Ends up being this one. This is what we were looking at last week. And as we came into this week, as we were breaking there, didn't look so clean. And the high was just off the upper parallel. Again, we turned right ahead of here. So a slight adjustment to the slope made it look like this, which still kind of gives us the break. But one thing I wanted to highlight is that that slope from last week, while it wasn't really clean on the break, look what happened on the recovery. Former slope support, now resistance. Here's the move lower. So whether you use this or whether you use this, you're basically working with the notion that we've broken uptrend support, a little bit of a risk for a deeper drawdown, near-term resistance 93.23, 93.40. Ideally, I'd like to see a reaction either here, 92.75, that median line, or down here, complete a 618. That's also last week's open. So nice confluence zone there to catch a possible intra-week swing low. All right, Eman says, hello, Michael, don't leave us that long. Time, please. We start trading upside down. No. Eman, great to see you in the room. I do apologize, had the in-laws in this weekend, so I took some time off, took the kids to the beach and all that, but yeah, we are kind of in poise mode still, Eman. Things are kind of, we did see some decent moves last week and into the start of this week, to be fair, but we're kind of in pause mode. You're going to see that holding pattern as we head into tomorrow's commentary. The big assumption, I don't want to get too off topic, but the big assumption, guys, is that Powell is going to come out and start laying the groundwork for taper. The fact that there was a switch last minute and they're saying, oh, it's going to be a virtual type of deal now, we're not going to have the, is starting to actually shift the notion that for some reason that might change what they say. I don't get it, but that's what the street, the word on the street is. In any event, I think the markets are poised for that already. I think we've been talking about the beginning of the talk about taper for the last, I don't know, 2 or 3 weeks or 2 or 3 months at this point, it seems, but it's been a while. So outside of any major policy changes, I don't, necessarily know how much we get tomorrow. That said, the technicals are pretty clear. Dollar turn just ahead of uptrend resistance. We're looking for a reaction at uptrend support that could be a little bit lower near 92.75s, max 92.50. Make sense? So that's DXY, number one. Interesting to see where this stands on the back or heading into Jackson Hole. The only other thing I wanted to highlight is here's what yields are doing. So the 10-year yield looks like it's made a little bit more of a significant low. We talked about that as we grounded this in early August and the breakout taking out downtrend resistance. You can see that's that same slope held support. It's messy. I know it's not the cleanest chart, but nonetheless it worked. Breakout, support, support, support. Here's the same key breakout level. It's the 38.2, the decline off the yearly high. It's downtrend resistance. It's former uptrend support. 1 touch, 2 touch, 3 touch. We broke below resistance, resistance. That's right there as well. So this whole spot, basically 137.50 into like 139, 140, let's call it, major resistance. We want to see a reaction here in yields. A breakout here would validate the notion, again, of a more significant low being in place. One other thing you want to note is that even if we make 2 equal legs off the low, we still all the way up into 46.80. So for me, it's all about this level here. If we clear this, 43, 146.80, even if this is corrective, still way room to get up there. Watch for inflection here over the next day or so. So that's the 10-year. Just a quick question, quick look at yields. Remember, again, as yields go up, price is going down. So if the sort of sentiment scare is done, you should see this start to actually climb a little bit higher. Okay, so that's the 10-year. Euro. Here's what Euro looks like on the weekly charts, and then we'll drive right in. So we've been tracking this one for a while. You guys know the big level that we've been talking about. There's been 3 of them. First is 1760. That lasted for 4 weeks before breaking. The second level was 1695. We've been looking at that for the last 3 weeks, essentially. The last level was 1620, and that's to complete 2 equal legs off the high. That's the swing low that you made back here last year in September and October. Then you had the 2016 objective swing high. They all line up right here. On a closed basis, that 38.2 is still, or that 6.1, that 38.2 at 1695 is still basically halting the decline. Here's what it looks like on a closed basis. downtrend support, 38.2 of last year's rally. So are we surprised to see a little bit of a bump in the euro? No. Same scenario that you're looking at here with the DXY. Possibility for a little bit higher of a rally in euro, ultimately looking to fade that, but not as telling as the DXY, where we got a close and a breach above the yearly opening range. This one basically closed right there. So you're at a very provocative spot for euro. Weekly chart, more to be desired. Here's the daily, and this is why, or this is where the risk, in my opinion, shows for a little bit larger of a recovery. Divergence all up into the lows, right? Lower low, lower low, lower low. No new lower low in the oscillator. Big reactions, that 38.2 at 16.95. Again, remember, that's the yearly opening range lows. Close below, one daily close below, inside candle the following day, and break back higher. Again, could be just a little bit of a bump off of downtrend support. Here's what it looks like on the intraday. And this is what I showed you guys last night. So all things held constant, resistance is still kind of the level I'm looking at. Median line resistance. If this uptrend is intact, again, the median line for this one is here too, resistance, resistance. That's still holding. We just turned a second turn off it. So maybe a little bit of a pullback. The risk is still for another stab, in my opinion, but ultimately we're looking to fade euro strength, ideally below 18, max 18.15. The weekly open comes in, stop traffic right at that same level of support we were talking about on the whole way down last week. So 16.95, 17.04, that's exactly where the weekly open is. So you've got a very interesting sort of pan out here where it's been a straight shot since we opened up. That converges on slope and the same lateral level we've been watching. All things held constant, ideal scenario, maybe a pullback to support, one last spike for a terminal move, or sort of a bigger exhaustion closer to 18. Ultimately, the ideal scenario is that we do break lower in euro. But from here, you want to use caution. If it starts moving lower, we're going to have to clear this slope, basically like yesterday's low is what I was looking for, to sort of validate the turn back lower to see if we can't make another run at that 16. Questions on euro? All right, that is number 3. Dollar CAD. Here's what Loonie looked like yesterday. So major run up into the close of last week, huge rundown into the open of this week. Here's what dollar CAD first on the weekly charts. Let me just take a quick look here. Big reversal off of slope resistance. Here's the pitchfork that we've been following off the lows. Uptrend resistance, uptrend resistance. Here's the pullback. Now, this thing is very, what's the word I want to say? We've seen this episode before. Okay, we've seen this episode before. Excuse me one second. Let me just expand that for you. Here's what happened as we were probing first on the breakup of downtrend resistance, pullback, huge run. Again, massive breakout in July, closed back lower. Massive breakout again last week, closed back lower. But at the end of the day, this is the largest spike into 60 that we've seen so far this year in momentum on the weekly basis, looking for support on the way down. Watch the weekly close as it pertains to the 52-week moving average. This is the first break we've seen above this year. In fact, since last year in July. So I do want to see if this closes back below, it would certainly risk a larger breakdown. All things held constant, we're still in the uptrend. The weekly chart, again, it's not necessarily your best friend here. Here's what things look like on the daily chart and the intraday. I think it's a little bit cleaner. So I've adjusted the slope just a bit. We were working with a slope off of these peaks. This is just a little bit larger of a gradient. I did a lot of slope work on this yesterday. It seems to be what fits price action a little bit cleaner. Caught the highs. The median line has seen pretty rapid acceleration on every break. So I'm going to work with this gradient right now, and all it does is it opens up where our more significant support targets are. So, maybe a little lower towards the 25% parallel would be 2560, but largely like a better bump would be down into this gradient. This is just a sliding parallel, the same slope. But again, it's been kind of stretched as of late right here. So how do you play this on the intraday? Look, if you're not already short on this, I don't really have anything to do on it. If you took a short last week, or even if you took a short early this week against last week's high, it'd be break even or better. But here's what it looks like. I'm gonna zoom this out to the 240. Here's the 4-hour to give you a better idea. From here, you could still see an extension recovery to 27.13. It wouldn't be outside the realm of possibility. So do I want to sit 100 pips on a trade here and let it go? Not necessarily. But like I said, if you're holding anything short from above this, here's your 38.2 at 25.89 holding support. Again, ideal scenario, a little bit deeper of a drive into one of these and look for a larger reaction. If we buckle below here, I'm not too, I'd let this thing sit out. 23.60s at that point is where I'd start to look for a larger sort of low, or the possibility for an exhaustion. But right now, I'm sort of focused on here. So something like this. Into this zone. We shall see. Questions on Looney? All right, that is number 4. Here is crude. So I think low's in place. Really, really strong rebound. It's been a one-way trip this whole week, straight shot up. It happened at a significant price and time. Okay, here's crude on the weekly charts. I haven't changed a darn thing. This is the 100% extension from the decline off the yearly high, noting again, for any of you who are interested in Elliott wave, usually your corrective moves against trend are going to be in 2 equal legs, and that's exactly what we got. A little bit deeper of a drive, right past 62.30, really strong rebound. Remember, before this break, guys, the level that we were talking about for months, actually this whole year, was right here at the August 2018 low week close and the 2019 objective high. It caught the highs last year. As we opened up this year, again, it caught the highs, held for 5 weeks before a breakout, massive acceleration. Then it was support. Last week, we tumbled below. This week, back above. If we close back above that 66 region, I do think that's sort of the nail in the coffin, that more significant lows in place. Now, this is a big call. I'm not going to put all my eggs in this basket, but that was a really strong reaction we got off a pretty significant price level. Watch the weekly close. If we close back below this again, I still think the risk is there for some chop sideways, but largely speaking, that's the focus into the close of the week. Momentum, perfect bounce, even ahead of 40, didn't even get into 40. Here's what it looks like on the intraday, or on the daily rather. Basic trend line, 1 touch, 2 touch, also converged on that 100. Massive outside daily reversal off the lows. That's bullish. So right on the bat, into the open of the week on Monday, huge green flag. Near-term resistance again, 65.16 to that 66 level, that level we were just talking about. Here's the breakout, testing the 100-day moving average. So we're here to see what happens. Again, a little bit of a pullback from here may be the scenario, but you want to see 65 basically hold as support. Upside, 50% retracement, 69.33. 71.13 would give us the breakout and sort of the resumptive move for the uptrend in crude. Here's what it looks like on the intraday chart. And here's what I showed you guys last night. So that actually did hold, right? I was noting that slope there. It actually did hold for a little bit of a pullback. Like I said, near-term support 66.14 would be the ideal scenario, right? If we hold bullish inval for the near term. On the upside, like I said, 69.33, 71.13, that's 618 converges on this slope. Now, again, we don't have too much. I just wanted to keep this on here, by the way, for the guys to see, visualize sort of the breakout. So I'm going to ditch this slope now, keep you focused on the operative trade. Here's a 120. So little toppy, obviously divergence into the high. Yeah, sure, could get a pullback. 66.15, 65 ideal scenarios for where you could spike, where you could find some exhaustion. That's, I don't want to drop that low, but that's bullish inval. If we push back below 64.20s, Friday's high, Thursday's high, you're basically just risking another dump into fresh lows. But big moves in crude, big moves in crude. Remember, the longer story, in my humble opinion, is still constructive, even if you take into account all the geopolitical stuff, energy prices and all the like. The question is this the resumption of the broader uptrend, or are we in for a couple more weeks of sideways movement before we actually move? We shall see. Number 5. All right, number 6 from last night is Bitcoin. I'm going to take a segue and do this a little early because I do think this is a very interesting juncture. Here's the same Bitcoin chart I've been showing you guys. Again, I want to show you the daily chart first. Remember that parallel that we've been following, possible parallel from the 2018 drop, kind of decoupled a little bit with this last move here last week. In time, you're sort of looking for that turn, essentially like in the next couple of days, max, before you turn lower, or before you resume higher, rather. So our focus was whether we turn before downtrend resistance. That broke. We've been looking for the upside, turned right ahead of that 51,000 region. And that's where the 618 of the whole drop off the highs are. So look, there's a lot of research. I shouldn't even say a lot of research. There's one major famous guy who, big Tom Lee, big Bitcoin trader, who's been talking about, oh, well, the 200 DMA and Bitcoin, whenever that breaks over the last, 10 years, Bitcoin's been a one-way trade with a rally of, 80 or 90% first. Okay, that's all good and dandy. Here we are straddling the 200-day moving average again, okay? If this buckles below, it's still constructive, but you have to allot the possibility for a washout near 42,000. That's going to be pretty painful. It's going to be noisy if it happens because everyone's already starting to reload back on their Bitcoin train. And I'm not going to, again, I don't want to be the guy, calling the sky's going to fall, but this is an outside day reversal here off the highs. So watch that 200-day moving average today. If we buckle below, again, I think there is a risk for a larger washout towards 42,000-ish. Okay, keep in mind that that median line comes in just around 44,000. But both areas of interest for possible re-entry if we get down there. Long side levels don't change, 51,000, 51,030, and then the bigger, steeper rally, 57,000 to 57.7 will probably be your bigger region. But the risk is there. We've been marking the ongoing divergence into the highs. This last one didn't even pump through 70. That held. If you look at the intraday chart, pretty similar scenario. This is the 4-hour. Okay. Here's a buckle back below the median line. Let's see what happens. Here's 42,000. Questions on Bitcoin? All right, that is number 6. Back to the commodity block, Kiwi and Aussie. So here's Kiwi. On Thursday, we identified a major key support, and that major key support showed itself both on the weekly charts, on the daily charts, and on the intraday charts. You can see it here on the weekly chart. It was the 100% extension, swing highs from mid-year of 2019. Daily chart gave us even a bigger sort of level there from 2017. The May low ended up being right around 68.17. That's exactly where this thing grinded into, into the close of last week. So that was the whole focus was, okay, nice buckle, nice drop, big support. Where are we going from here? Here's Kiwi dollar now. Oop, wrong charts. Okay, that ended up being the low, guys. That was the low right here. Here's Friday, here's Thursday, here's Friday. Now, we ripped into the open of the week. 2019 HDC 68.90 took that out. 69.40 2019 high took that out. August open is where you're straddling right now at 69.69 on mounting divergence in momentum. Looks like the stretch looks a little tired. So again, that same trade that we looked at with the DXY, not so clean on the euro, but the DXY, that stretch looks a little tired. Looks a little tired. So, you know, if we pull back, 68.90 would be where you don't want to draw the level. Like if we're going to bounce and see another stretch, that's what would be the hold. But not really keen on trying to fight this any further. Really nice rebound off support, I'll grant you that. But we're starting to get a little tired. A 38.2, one level that wasn't on there because we didn't have that low registered, is the 38.2, and that comes in right around here. Here, it's at the 70 handle. So if you're holding longs, if you have a decent position, it's like the same position that we talked about. If you have anything long from like sub 68.90, yeah, maybe go break even or better, or put your stop there and have the limit, you know, into the 70 handle. If we get a 38.2, the entire drop wouldn't be so crazy, right? Just from this drop off the highs from May, you would still, you know, run into the 70 handle. But for all intents and purposes, you know, we're testing monthly open resistance, former monthly open support, now monthly open resistance. Could get some kickback from here. Could get some kickback from here. Questions on Kiwi. Aussie's in a similar scenario, only if we had to choose one to try to short, obviously you don't want to put all your, you don't want to load up with long dollar exposure on everything once you know this dollar pullback starts to fade. But Aussie looks a little bit more impressive in where it is on the weekly chart. So remember this, insane, right? 73.29. We talked about it. It seems like for 3 months right here. That was the actual swing low from May of 2017. Huge pivot in price, support, resistance, 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 breakout, acceleration, support, support. You had uptrend support there. You had downtrend support there. Obviously, as we always like to note, a break of downtrend support oftentimes can be the fastest, quickest, sharpest part of the decline. We saw that last week as this thing plummeted into stop traffic, the 1618 extension. 71.22 was a beautiful call, really strong rebound, and a really nice play actually for the recovery. That recovery, by my estimates, my humble opinion, is now back at resistance. The first level is 72.81. The second level is 73.20, the same level we were talking about this whole drop. Key levels of resistance for Aussie. And that's a deduction that you can make off the weekly charts. What does the daily chart say? Similar scenario. Similar scenario. Here's Aussie on the daily chart. Same two levels, 72.81, 73.28. You can see, again, I would envision it wouldn't be too far off for this thing to still make a stretch into, wait 1 second, not only is it that swing low, it's also the objective monthly open before you check back again. But broadly speaking, we're looking for exhaustion off of one of these two levels. Now, if we breach and close above 73.29, that's actually, in my humble opinion, that would be a pretty big reversal pattern. That would be the risk of a larger rally that a more significant low is registered. Not my ideal scenario, but that's the if-then trade that we're looking at. All things held constant, former slope support should be resistance. Here's what it looks like on the intraday chart. Zoom this out to the 240. Again, 72.95. That's actually a soft target from the 2019 high, but you get the picture. Area of resistance right here. Ideally, looking for exhaustion ahead of here. Downside targets don't change. In the event of a break below 71.21, you're looking for 70.50 and right into the 70 handle. 70.16 is the 2020 open. Questions on Aussie. Again, there's not much data to take into account to the close of the week, but tomorrow it's going to be commentary from Powell, and we do get the July PCE number. Remember, the Fed's preferred inflationary gauge, the personal consumption expenditure. So what kind of kickback you get from that? You know, it's already expected to be a pretty strong print, 3.6%. We already got a 3.5% clip, which is like a I think 20-year high or something. So we already know, guys, that the inflationary picture is spiraling or accelerating. Their view is that this is transitory. And that's why the hold on rates necessarily won't be something that's going to be shifting as quickly as the expectation for when and how fast tapering begins. So it's going to be an interesting day tomorrow. Any questions here on Aussie? That's number 7 and 8. Dollar yen, number 9. Here's what the abomination looks like. It's been an interesting trade here too. I think this thing is, actually, I take that back. I don't think it's an interesting trade. I think it's a quite boring trade, in my opinion, but that's just me. So what am I looking for here? Already got you on that. So Aussie, we already covered that as well. Here is dollar yen. So this is what it looked like last week on the 16th. It looked like we were breaking downtrend support, but then we said, whoa, wait 1 second. That June low, or uptrend support, that June low and that 618 gave us 109.07 into 109.18. So while the slope looked like it broke, that was a key level. And so it kind of put us on pause, and it's a good thing it did, because that was the low. We literally rallied right off that to close the week. And then here's this week, still holding essentially the weekly opening range. I mean, it looks like we're trying to make a break higher, but again, I'm not doing anything with that ahead of Jackson Hole. So here's, I'm more inclined to ditch. Here's what it looked like, again, just for comparison's sake, the side by side 120. For just clarity's sake, I'm willing to sort of ditch this slope and just work with this as a basic consolidation pattern. Okay, a series of higher lows, a series of lower highs, and you're basically looking for some sort of consolidation break. I think this one takes clear directional guidance from tomorrow, or so from the commentary that we get, both from Fed officials. I don't know if PCE will certainly be a bigger player here, but also watch this in relation to what we see in yields, right? That's been making a push too, with the 10-year in almost a similar stance. That's the 10-year yield on the 2-hour. Here's dollar yen, right? End of the day, I'm still going to work with 110 as sort of my near-term bearish inval. That was our gut check last week. We did go through and reverse, I recognize, but hey, it's the abomination. That's what the abomination does. One other thing I would just put as a caveat is the extension off of the low for the 100 gives you like 11.19. So I just bring that up here because past 110, it's basically like another 60 pip run before you run into anything major. This year's high day closed 111, but even if it gets into 111.19, I don't want to make any calls for the resumptive trade yet. You know what I mean? So it's the abomination. All right, last but not least, I don't know, Eman, if you've been trading gold or you've been checking out this thing, but it's been super lackluster, okay? Let me take you back first to the weekly charts. Here's what gold looks like on the weekly. big, massive inflection off of critical support. We talked about this 3 weeks ago. Since it's happened, guys, it's been a pretty quiet ball game. Okay. The bearish invalidation for the broader trend off the yearly highs from last year and this year is still 1825, 1850. That's still sort of your key resumptive breakout zone. So as we were rallying, not too surprised if we see some kickbacks, some more consolidation sort of creep up into here. You're no man's land here. You're not near resistance weekly standpoint. You got the 52 week again there also. You're not near weekly resistance. You're not near weekly support. You're right slap in the middle. So when you see something like this materialize on the weekly chart, not so surprising that the intraday doesn't look all that much better. Here's what it looks like on the daily chart. Massive rebound. Here's what it looks like. Levels we were looking for resistance here and here. Again, this is your objective monthly open. This is your objective 100-day moving average. We came right into that zone and pulled back. Okay, momentum failing right at 60 or ahead of 60. So look, you might be in for some more back and fill. The major support, or at least the first major pivot level, would be 1760 on the downside here for gold. If we do take a quick retracement, a 38.2 even leaves room to 1760 as well. So, you know, I think you're in for a little bit more of a setback in gold, but ultimately, again, you look to buy that. Here's a near-term consolidation I was looking at right ahead of this webinar. Again, this is your weekly open. If you break lower, 1770, excuse me, 1760, really nice spot. Start to look for inflection if gold does break down. At the end of the day, resistance at the monthly open, need a breakout above 1830. I had 1850 there on the weekly chart. That's the high we close. So 1830, 1850, you know, on a clearing side for the weekly chart to validate breakout, but that would be a break of last month's high and this month's opening range high. Really nice levels. Questions on gold? Yes, Michael, I was long 3 weeks ago at 1730. Well done, man. But I'm out now, as I did take profits at 1768. Well played, well played. So I don't blame you. 1768, a little bit early on the gun, maybe, but I don't blame you. Win's a win. 1795 for me was kind of the big region. I thought this was going to give us a bigger kickback. Former support, breakthrough, resistance. I thought you were going to get a bigger kick there. So you pop through and pull back. I think it was a prudent move, Eman. In the meantime, my hands are off. Yeah, I don't blame you. Well played. That's exactly the prudence that a seasoned trader takes. So from here, you're likely maybe to even get another decent entry again if we get sort of a more corrective stance from here. But it's been a real kind of one-way shot to the top side. I want more back and fill. So I'm actually I'm cheering this on if we do get a little bit more of a crack lower, possibly reset this trade. Okay, guys, that's everything that's on my list. Let me know if you have any other questions or trade setups you are looking for. We will be back next week. Again, Monday, I'll have a free session on Daily Effects. And I'm actually going to have a secondary session, guys, on Daily Effects on Wednesday for the midweek that I alternate with there every 4 weeks. So I'll be there, and then we'll be back here again on Thursday. So we'll get 3 sessions out next week. Look, heading into the close of the week, tomorrow is really, I hate these Jackson Hole things. Sometimes they prompt really great trades. More often than not, they don't, unless there's a policy change. And I really don't know that the policy change, if it were announced, leaked, suggested, commented on, I don't know that in this scenario will necessarily give all that, because we are expecting talk of the taper. If you're not expecting talk of the taper at this point, there's something wrong. You're not listening, you're not looking at the markets, or you're oblivious to the fact that even just yesterday or this week, you know, Congress, again, we've already allotted another, 1.5 trillion into the bucket, which is already just sloshing around. So there's really no, in my opinion, sort of big wow moment here if they say, you know what, we should start tapering, and we should start tapering probably faster than expected. Rates, on the other hand, those are still sort of the anchor that we're going to be looking at for quite some time. So the commentary tomorrow is the biggest event risk that you'll see. Core PCE, like I said, the expectations for the core personal consumption is expected to be 3.6. That's above the 3.5 we got last month, which was a 30-year or 20-year high or something. So inflation is going to be something the markets will be looking for in the commentary tomorrow from Powell. I think he's going to stick with the transitory theme, but more so it's going to be the taper talk that really, I think, moves the needle. So stay nimble into the close of the week. The dollar has seen a pretty decent move. If we do get some more gyration, a little bit more of a deeper cut, again, we'd be looking for basing. But at the end of the day, we're coming off uptrend resistance, looking for a move off uptrend support. Same to you, Eman. Thank you. Have a lovely weekend to you as well. Jay, Steve, guys, have a great weekend. I will see you on Monday. Cheers.